Hi everyone, this is Al Brooks. Thank you for watching this short excerpt from my Brooks trading course. Today is January 1st, 2019, and Cam asked me to give my outlook for the coming year for his tradingnut.com website. This is a monthly chart of the E-mini, and I'm going to use it to illustrate my thoughts about the stock market for the coming year. Going back to 2019, the stock market has been in a very strong bull trend. It went sideways here for a couple of years. The bears had a chance at a top, but usually the first reversal in a very strong bull trend does not get very far. It usually leads to a trading range, and then the bull trend resumes, which it did, and it resumed very strongly. In October, we had the biggest bear bar of the entire 10 years, and then in December, the body was even bigger than the bear bar in October. Something is different. Much bigger bear bars than we've had in the entire 10-year trend. Also, for the bears, they have a slightly higher high double top, and December closed below the lows of the 2018 trading range, and far below. The question everyone has is this just a pullback, and will we get a new high, or is this the start of a swing down? For example, a measured move based upon the height of the double top. We have a double top, we have a neckline, and measured move down takes us here back to that 2014-2015 trading range. This might be the final bull flag, and if it is, the market typically corrects down to near the bottom of the range, which is around 1800, and that would be about a 40% correction from the high. I do think we're going to get there within the next few years. At the moment, I think we have a 40% chance of this working its way down there over the next couple of years, and a 60% chance of the market staying sideways, maybe making a slight new high, and then going down there. If we do get a new high over the coming year and then a reversal, we'll have an expanding triangle top. 1, 2, 3, and then we have a lower low here. In any case, this is the target, whether or not we go to a new high first. 40% chance we get down there without going to a new high. I think it's really important to understand that every bear trend ends at a monthly support level, usually a trend line. And the bulls are hoping that December was a test of this green line, 2011, 2016, and therefore we're going to bounce up from the trend line and go up to a new high. That's possible, but I think with December being such a big surprise, we're probably going to get a second leg down. Whenever the market does something surprising, it traps both bulls and bears. The bulls were surprised. They were hoping that the market would find support at the February low, and then the bull trend would resume. Instead, we broke far below the February low, and many bulls who bought during 2018 now are trapped into losing trades. They're going to use any bounce to get out of their longs with a smaller loss. So the bulls are going to sell a rally. A lot of bears did not sell on the breakout below the trend line, and they did not sell in October, but now they're confident that we're going at least a little bit lower. The bears will use the first rally to sell as well. So right now the odds are the December low, even though it fell exactly 20% to a bull trend line, it's not going to be the final low. Also, if you look back over the past 100 years, every time the market has fallen 20%, what happened next? So for example, if you did some kind of a study on TradeStation or any other stock market program, and you searched for every time the market has fallen 20%, and then looked at what happened next, how many times has it fallen 20% and immediately gone back up to a new high? Well, the answer is 0. Most traders know that there have been 32 times in the past 100 years when the stock market has fallen 20%. None of those times did it fall 20% and then go up to a new high. Every one of those times, it fell 20% and then more than 20%. On average, it fell about 30%. And therefore, even though we have a little bounce here at 20%, chances are this is not going to be the final low. Chances are we're going a little bit lower. I don't know if it'll fall 22%, 25%, 40%, all the way down here, but chances are this is not going to be the final low, because in the past 32 times when it fell 20% and ended up falling more than 20%. This is a weekly chart, a trading range for a year, about 50 bars, and we broke strongly below the bottom of that range. Everyone who bought during 2018 is now holding a losing trade. They were hoping the bottom of the trading range would hold and that we would go up to a new high, and the bulls are now trapped. And they don't like the size of this sell-off. Most of those bulls, or a lot of those bulls, are going to use any rally to sell out of their longs, and that will result in a second leg down. And the bears are very happy by the size of the sell-off. They're hoping that the rally last week is simply a bounce off the monthly bull trend line, and that we are in a bear trend forming a series of lower highs and lows. We have lower high and we have a lower low. They're hoping the bear trend goes back down here to that 2014-2015 trading range below 2,000 down to 1,800. As I said, they have about a 40% chance right now of achieving that goal. But if we go down here or here, instead of 40% chance, it becomes 50, 60% chance that this sell-off will end up as a 40% correction. When a sell-off is very strong like this, the first reversal up is usually minor. Bears will sell it, bulls will sell out of losing longs with a smaller loss, and we'll get a second leg down. So the odds are, even though we're trying to reverse, we're going to get at least one more leg down below this low. And if we do, let's say we come down here and reverse up, then the bulls will have a wedge. 1, 2, and then 3. Other computers will look at the wedge as 1, 2, and then 3. And if they get a reversal, then they'll have a better chance of going back up either to a new high or to this high. It's near a prior high here. We tried to break above that level here, failed. This is the start of a very strong sell climax. If we do get up there, the bears will try to get a double top. They'll try to break below the neckline and fall for a measured move down. And therefore, even if the bulls do get a very strong rally into early 2019, it's probably going to have a hard time getting above this high. The best the bulls will probably get over the next few months is a trading range. More likely, we're going to go up for a few weeks, maybe 3 weeks, maybe 5 weeks, form a lower high, and then get one more push down. And that leg down will be very important. Will we get a reversal? If so, we'll have a wedge bottom and probably we'll get a rally lasting several months. If not, we'll go down to the 1,800 level. I want to say one other thing about this chart. We got very close to the 20-week moving average here, but in fact, we did not touch it. This was about 65 weeks without touching the 20-week moving average. Last year, I talked a lot about that being the most extreme buy climax in the 100-year history of the stock market. If you look at the Dow, if you look at the S&P 500, same thing, about 65 weeks without touching the moving average. Never happened in the 100 years of the stock market. Therefore, it's unsustainable and climactic. It's extreme. The monthly chart, January last year, we had 15 months without a bar falling below the low of the prior bar. So a 15-month bull microchannel. That had never happened in the 100-year history of the stock market. Another example of an extreme buy climax, the most extremely overbought the stock market has ever been on the monthly chart and on the weekly chart. The daily chart went over 400 days without a 3% correction. And I forgot how many days, but also a very long time without a 5% correction. Longer than any time in the 100-year history of the stock market. So another example of the most extreme buy climax in the history of the stock market on the daily chart, on the weekly chart, on the monthly chart. Unlikely you're going to get a small or a brief pullback. When you have the most extreme buy climax on all 3 time frames in 100 years, chances are the market's going to have to go sideways for a long time before it works off that climax. Back here in the fall on the weekly chart, we had an unusual pair of consecutive bull bars closing near their highs. I said at the time that we're probably getting near the end of the rally. And then here in January, we had one more big bar, big bull bar right there. And at that time, I said, this is it. This is probably going to be the top. We're probably going to get a couple legs sideways to down. And we did. 1 pullback, 2. It turns out it was 1 pullback to a new high and a bigger 2. An extreme buy climax like this, you have to assume the bulls are extremely exhausted and they'll take a long time before they buy again. Daily chart. This is actually pretty interesting to me. We have a lot of bear bodies here on the daily chart. In fact, we have 10. And the E-mini has been in existence for 20 years. Never in the 20-year history of the E-mini has there been 10 consecutive bear bars. And therefore, using that measure, this is the most extreme sell climax in the history of the E-mini. In fact, I look back many years prior to the start of the E-mini 20 years ago, and I did not see a single time in the S&P 500 when it had 10 consecutive bear days. I suspect that never in the history of the stock market, 100-year history of the stock market, did it have 10 consecutive bear days. And therefore, on the daily chart, this is the opposite of what we have with the bulls on the daily, weekly, and monthly chart. The market is doing something it has never done before, and therefore it's an extreme climax. Here on the daily chart, we have an extreme sell climax. The bears are exhausted, and they'll probably wait for at least a couple legs sideways to up before selling again. If we do go to a new low over the next couple of weeks, the bulls will probably buy it just like they bought here, and the bears will get a second leg sideways to up. 1 pullback, 2, or 1 pullback to a new low, and then 2. In either case, the odds are we're going to be sideways for 10 or 20 bars at a minimum on the daily chart, which means at least 2 or 3 months. The daily chart is telling us that the market's probably going to be in a trading range over the next few weeks. Monthly chart, we're probably going to be in a trading range for many months, possibly a year or more. And weekly chart, same thing, extreme sell climax. The best the bulls will probably get is a trading range. Weekly and monthly chart, odds are we have not seen the final low. We've fallen 20%. That's officially a bear trend. We're probably going lower, but no one knows yet how much lower, 25%, 30%. And 2019, of course, there's going to be a rally, but it's probably not going to lead to a new high. If it does lead to a new high, it probably will have a hard time maintaining the high. Chances are we're going to get a sell-off. Bears are going to sell any rally, even if the bulls are lucky enough to get a new high. In conclusion, the upside for the bulls is not good. The bears might get down to 1800. Right now they have a 40% chance of that. 60% chance 2019 is going to be sideways with big swings up and down. Also, think about it from another perspective. When the market is collapsing, as it has been, are you looking to buy and hold? Are you looking to buy Apple or Amazon with the intention of holding for several years? No, you're scared. Everybody's scared. The pension funds are scared. And as a result, it's unlikely that we're going to get buying and then more buying and then more buying. Nobody's going to want to buy high. No one's going to want to hold on to positions. And that's another reason to expect that the market is going to have a very difficult time rallying, at least for the next many months. I'm Al Brooks from the Brooks Trading Course, and thank you for the opportunity to speak to you about my outlook for 2019.